Good morning, good afternoon, and good evening to our global crypto fans. You have another episode, as always, with our moderators in chief, the put together and very studious. You can see Matt Reed is already just reviewing his notes over there. We're super excited to have another great show on the line. We actually have a guest speaker today, which always makes these a lot of fun. We have Niklas Henke, who is joining us. He's going to have an opportunity to introduce himself. He's actually based out of Germany, so we're doing multi time zones. We're going to have one, I think, with 3 on pretty soon. We'll do like U.S., Europe, and Asia, just full across the globe. Niklas, welcome. Thank you so much for joining us.
Yeah, thanks for inviting me.
Excellent. Well, so usually we have this as a happy hour, but I know we're doing a morning session to try to keep things convenient for you as well. So I know Carlos usually has his Patriot water. It looks like he's just drinking a cup of Joe out of his fantastic Nebraska mug this morning.
I mean, you can take the boy out of Nebraska, but you can't take the Cornhusker out of the boy. So
love it.
I've got my trusty Nebraska mug on me today to remind me of all of my disappointments in college football over the last 20 years.
Do you do cream and sugar or just black? What do you? Is that tea? What do you usually do for the morning?
I've actually switched over to Four Sigmatic, like mushroom coffee.
Is that actually nice? I heard it's got a very weird flavor.
Does it just jolt you awake?
Well, it doesn't jolt you awake. It's got about a quarter of the amount of caffeine as a normal cup of coffee, but then it has lion's mane, and a few other nice things. I'm trying to cut down on my total caffeine consumption because I've been getting very, very jittery and anxious, and I suspect my cortisol levels are through the roof. So, my mini trying to stay around longer for the kiddos health kick is driving me towards coffee alternatives. It does not taste good, by the way, Matt. You are correct.
I was going to ask.
It is. You get used to it, and I think that the key here, and it's just like doing any other sort of, like, if you eat like a plant-based substitute for meat, if you think of it like it is a substitute for meat and it should taste like a burger, like, you're wrong. Just think of it like it's its own thing, and then you're
I'm drinking ground up mushrooms.
Yeah, it's like I'm drinking powdered
dirt,
mushrooms right now. Yeah,
let's just level set on expectations.
It's fantastic. Yeah.
I mean, if I really want to wake up, I might just go out to the backyard and just eat some dirt. I'm definitely going to wake up.
Yeah, sure. I mean, it's a great the things we do for our kids. But
that's good, man. That's awesome. I have a buddy of mine that like raves about that. He'll mix it in a little bit. Do you add creamer or sugar or anything like that to it?
I do, but I'm also, as part of the health kick, trying to avoid, excessive dairy and even those sugar alternative stuff. I'm somewhat dubious about it. If it's got 0 calories and it tastes like that, I don't know what sort of black magic they're working behind the scenes, but it can't be healthy for you.
Yeah.
You're going to get kicked out of Nebraska next time you go back if you don't want cream or dairy.
No, trust me.
They won't allow you in.
I started eating a salad in my 20s, and I was just officially, they're like, you're no longer welcome here, buddy. So that's already done and passed. At this point, I'm a full-fledged New Yorker / Connecticut and whatever you call people from Connecticut.
You're 2 steps away from that hippie life, drinking ground up mushrooms instead of coffee replacement. Getting close.
That's my next gig. Is I'm going to start an ashram in upstate New York.
What are you drinking in Germany, Nicholas? Is it?
Yeah, so I personally have I'm trying to move back to coffee from drinking like pre-workout boosters that have like twice the amount of caffeine in them.
C4, yeah.
So my trip
just get like straight IVs of caffeine into your veins.
Love it.
Yeah, so I've tried to stay away from that and drink more coffee instead, which I guess might be a bit more healthy. So yeah, but it's mostly coffee actually, especially like in the morning hours.
Yeah, it's a good point on the anxiety thing though, Carlos, because my wife was getting it as well, and we bought a mocha and eventually realised that we were having like 8 shots each of coffee with each cup.
Wow.
So like eight espressos in a row.
Yeah.
And then she cut it down to and doing that a few times a day, and then cut that down to like decaf, like half and half. It's made a huge difference. Doesn't get the shakes or anything.
Yeah. That's I'll even drink decaf coffee just to as like a placebo. Like my brain just thinks I'm drinking coffee. Like so, I must be energized. I'm drinking coffee.
It does.
Guys, lot to jump in today. I'm really excited that we have Niklas on. Niklas, I'd love to introduce you, but maybe before I do that, to kind of help set you up a little bit. So we had our conversation last time, and we talked a little bit more about DeFi and central limit order books and automated market makers within the DeFi space. And Carlos provided a little bit of news that DeepQ Digital is going to be moving on to on-chain. And they're going to be getting a little bit more active in liquidity provisions within on-chain protocols. So I thought for this episode, what we were deciding was to dig a little bit deeper into that, talk a little bit more about DeFi and capabilities with a quant trading perspective. So that was just a little bit of backdrop also for the audience out there, the reasons why we're setting up this call. But I'm not call, gosh, it's still early for me, so that's why. Niklas,
you're still breaking out of your like TradFi training. What's the purpose of this call,
habits
everybody?
Die hard.
I know. Robert just feels like he's missing something right now because he's not wearing a tie.
I got my hoodie on. I was like, "Wow, it feels
like I feel so
a little naked." I don't know. Like, it's like maybe I'll wear an ascot next time with the hoodie. You know, just try to balance it out a little.
Or like a bolo tie.
What is a bolo tie?
Oh my! Like those like Texas Oilman ties where you just have like the little slide and it's got two little tassels coming down.
Oh, that's like Colonel Sanders on the.
Well, that's a bow tie.
That is
a bow tie. I'll send you a picture. Trust me.
Please do.
They're classy.
Please do.
You'll love them.
Nicholas, you and I can wear one next time when you come back on the live show. Nicholas, why don't you give a little bit of a background introduction yourself? We're really excited. Obviously, Carlos and Matt mentioned that you all have been partnering together a little bit more. So if you could walk us through your background and your business, that'd be great.
Yeah, so I'm a theoretical physicist by education. I studied maths and physics, and then I did a PhD in mathematical physics, actually. And in this time I studied, my research was at the intersection of quantum field theory, string theory, and a lot of fancy maths. So think of like Big Bang theory, the kind of things they discussed there. It's somewhat similar to what I've been researching. So a lot was there on like actual mathematical structures, a lot of geometry, number theory, and algebra. So this is like very, let's say, analytic, which is maybe a little bit in contrast to what is often being done in quant finance, where it's a lot of statistics, right? I started to read about crypto almost 5 years ago. So now when I did an internship in financial services technology consulting, and this was the first time that I read about crypto, and I'm still very much drawn towards it. And I think this analytic background of mine is very well suited for this, or it gives me an interesting way to access it and think about it. There is what really intrigued me the most is this kind of way to program money in a very algorithmic way, which seemed absolutely fascinating and still does today, actually. So that's how I got into this. Then during the PhD, I actually started a sort of crypto asset management startup as a CTO, which unfortunately, ran out of money, more or less. And then I've now sort of started to use my experience, the experience that I made over the past years, and do this sort of as a consulting gig at other places, and done so at DeepQ for the past few months.
Yeah, so we actually met Niklas through his former company, and I was just extremely impressed by how smart he was. As you can tell by his background, he's kind of a dummy, and spent a lot of time, obsessing over inconsequential and very rudimentary things.
Yeah, coming up with weird symbols, like our own language that no one else understands, these kind of things.
Yeah, so I was like, why don't you actually do something meaningful for your life? I'm joking. But point being, we were very, very, very excited when he had some bandwidth, and as we were descending down the rabbit hole of trying to get DeFi going over at DeepQ, it was sort of a no-brainer to partner with Niklas and engage him as a consultant to kind of help us navigate, primarily just sort of navigating that mode of thinking from traditional finance, CeFi world. Like, we're very, very, very used to the concept of a central limit order book. Like, we can make a market there, we can use the analytics. That's our edge as a company. But obviously, DeFi is such a massive portion of the entire crypto market. As context, for example, like Uniswap does more volume on a daily basis than Coinbase does. So if you think about that from a liquidity perspective, if you're just completely neglecting one side of the market, and not to mention the side of the market that probably has the most growth potential and the most exciting things going on, then you miss a lot of what's going on. So we're incredibly excited to have Niklas on to sort of help us understand better the way that we think about DeFi, the way that we implement for that in terms of like merging our TradFi background with a DeFi technology stack, and I think it's going to be a really interesting conversation.
That's great. Love it. Welcome, Niklas, again. Looking forward to picking your brain a little bit more. I'll try to. Now that I know you're into quantum field theory, I'll probably ask you a bunch of nerdy questions afterwards. It's a very interesting.
Feel free.
Yeah, fantastic. Look, so I know when we were chatting about DeFi a little bit more in detail last time, talking about the differences between automated market makers and central limit order books, and how all this plays out into the broader DeFi space. But like, maybe what we can do here is talk a little bit more also like broader themes, like what kind of DeFi problems are still outstanding, right? So like, there's been, obviously you have like Uniswap has come in, they're dominating the DeFi space as a on-chain trading venue. They've been going through various iterations trying to find ways to mitigate impermanent loss that we see as a big problem in the DeFi space. So maybe we want to talk a little bit more about what are some of the challenges or problems that are still outstanding in the DeFi space.
Yeah, so I think one of the things that makes DeFi also a little bit unique, and a lot of this is due to it being still in the early phases, is that you have a lot of liquidity, but that's fragmented across many different venues or even chains. And so this, for example, gives rise to a very interesting competition and trading strategies in a different way. So this sort of leads to the world of MEV, where it's all about on-chain crypto arbitrage between different exchanges, for example. And this is something.
So can you define what MEV means to someone that doesn't really understand sort of the DeFi jargon?
So the term itself stands for maximal extractable value, or it previously originated from a different term that was called minor extractable value, but we've moved away from proof of work, so that doesn't really apply anymore. And roughly speaking, I would classify it as like on-chain arbitrage. So due to the liquidity being very fragmented, you have many different markets that try to do this same thing, right? You might have very many different pools that all try to enable trades between ETH and USDC, let's say. So you have a lot of different prices for the same thing, and that gives rise to a lot of, like in this case, very simple price arbitrage. But then this world of MEV is a bit larger and uses many sort of very unique properties, technical properties of blockchains, and so you see a lot of front running or even back running, and all of that has to do with the way that transactions are being sequenced or included on chain and then processed. So that's a space that's very unique to DeFi and extremely competitive. So maybe in a lot of ways similar to high frequency trading and TradFi, but in a like Twitter, crypto Twitter way, where you do a lot of these things and post a lot of things about it.
So it's somewhat interesting to think about the concept of back running, right? Because I mean, in a CeFi world, it's all about who's the fastest to the exchange, because all of these things run on a pure price time priority. So if you get there faster, you get the trade first, you make more money. What constructs allow sort of this backwards and forwards ability to front run times? I guess how's that different from DeFi to CeFi?
So I would say that really the special thing here is the purely algorithmic analytic nature of the blockchain. And you have liquidity pools, for example, and they're in a way purely determined by a formula that tells you, given the current state and given a transaction like a trade, what will be the next state of the world. And that in a way is similar to a central limit order, but where you have this as well. But what is different is that this is run on like a globally distributed state machine, a global computer in a way, the blockchain. And so the way that this is handled is that you order the transactions that come in, the trades in a well-determined order. So you can know which transaction happens first and which happens next. And usually the way that this happens is by paying the gas fee for this. And the higher fee gets included first in a block, so the transaction that pays more has the priority. But you can sort of see this and pick this up. There is this global, what is called mempool, the global pool of transactions or trades, let's say, that should be included in the blockchain, that should be processed. And so if you're smart, you can look at this and pick up some transactions and see sort of, okay, I know this transaction pays us a certain fee, so I have a decent conviction when it will be included, when it will be processed, and sort of in which order. And you can use this particular property to sort of create your own transactions, and you can set the gas fee in such a way that you can make sure that your transaction is either processed right before this transaction that you're targeting or right after this. And since you know the state of the world at this moment, you can compute all of this based on like these transactions that are outstanding and the way that they are processed. You exactly know sort of what it will be the price right before this transaction, like this trade that you want to target happens. What will be the price right before that? What will be the price right after that? And you can use this to, I don't know, trade price differences or abuse like wrong slippage settings. If someone has not configured the slippage tolerance in a good way, then you can abuse that and essentially so in the end, what you do is you siphon off funds from normal users that are not careful enough. So that's also why this front running in particular is well. There's a lot of discussion around this in this space, whether this is something that is good for users or not.
Let me summarize. So I understand. So for using the Ethereum blockchain, for example, you'll put in a maximum price that you're willing to pay for that transaction, and because it's a public blockchain, all that information is public. So any other market participant can see these transactions sitting in the queue and what pricing they're willing to pay. And if it's a large enough order, if you can calculate market impact or estimate market impact, and then figure out if there is a profit by paying a premium to what they're paying for that transaction in order to beat them. So there's a constant fight though, but and then I see. So it's almost like a battle that can happen even pre-transaction, right? Like in regards to who's staying in what order of the queue.
Yeah, you can see these exact battles actually, because the way that you manage this is by modifying the gas fee, the amount of the amount you're willing to pay for this transaction. And what you see a lot is that once your transaction gets targeted and someone puts one transaction right before it, you can increase your gas fee just a tiny little bit to get in front again, and then the other one gets in front again and again and again. So there are a lot of shenanigans that are being done in this way. And actually, sort of, that's also another argument why this is not so good for the ecosystem, is that this is leads to Yeah, and it leads to a lot of congestion. Like it fills up the blockchain with these kind of shenanigans, which are not really actual trades that or like actual flow that should be served to the exchanges.
Is shenanigans German? Is that a German term?
I don't know. I don't think so.
I love it, by the way.
I love it.
I frequently use the word shenanigans as well when it regards some of this like order book gameplay. But I think the interesting thing for me really is if you think about like CeFi, it's this race to the bottom for speed. And so you don't really get to flex your analytical muscles very much. If you look at like a lot of the models and a lot of the trading strategies that are used in the CeFi world, it's all very simple. We're talking like, linear regressions and very simple arithmetic to sort of like understand what to do and place your order the fastest. But because the nature of blockchains allows you to observe things slowly and see the queue as it's building and interact with the queue before it actually settles, you get all of these shenanigans and you get this game theory and you get this sort of stuff that I think makes it very interesting. I think Niklas brought up a great point, which is as a market maker in the DeFi space, we are still nascent. And one of the things that needs to be really fleshed out and really understood is what are the ethics of the market structure? And how can you be a responsible and an ethical market maker and still live in the DeFi world? Full disclosure, MEV is not our strategy. So when we talk about these sorts of things, I want to be like very clear that just sort of as a decision as a firm, I'd rather leave money on the table than engage in what I would call like unethical market making behavior that disadvantages users. So like I'm not going to say MEV is bad or that we will never do MEV, but if you do MEV, I think that you really need to be cognizant of what sort of like the ethical consequences of your action are, and as the market structure develops, sort of how will these things change? How can we sort of interact with venues as well as create new protocols that potentially help these things to become a bit more clear and to add some protections to the market structure itself. So I guess that's my full white hat disclosure.
Very good. I was going to say, Niklas, so one of the interesting things that you brought up for me was the concept of reorgs and how they work and how you have, because it is a distributed system, there's different time disparities and someone may be working on a different set of transactions in one geolocation versus another. So I thought maybe you could just give a bit of colour on that, how blocks are settled and how that gives rise to some stuff.
Yeah, like you said, like the blockchain is a distributed system, and sort of one of the key things that you have in all distributed systems is that you can at best be eventually consistent, right? You might have transactions happening at the same time but at different locations, and then once there is a latency when propagating them throughout the entire network, especially if that network spans the entire world. And so at times there will be sort of collisions in about what the true state of the world is. So blockchains handle this sort of at the consensus layer. That's completely designed for this purpose, to settle on one unique state. And in blockchains this happens more or less, the largest chain wins, right? If you have, the way that blockchains work is you stack one block on top of the other and you link them in a nice cryptographic way. And then the way that you decide which is the true canonical chain is you just look who has, well, the highest block number. And back from when we had proof of work, the idea behind this was sort of, this makes it secure against attacks, because it would take a lot of effort to create, to mess with the chain and then create a new chain that is larger than the current canonical one. Nowadays these are secured a little bit differently. But anyways, the point is that if you observe the state of the world, like the blockchain, from from one location, your own location or your data center's location or whatever, then it might happen that at this location you get the true state of the world, the current state of the blockchain, but then suddenly you're made aware that at a different place in the world, for example, someone else came up with a longer chain, so that's actually the true state of the world. And now you'll have to, well, take care of the difference. And what you do is you have something like a chain reorg. You essentially say that the previous, you go back to the last point where the two chains matched, and then you remove the blocks that you had that are no longer part of the canonical chain, and you again reappend the ones that come from the different larger chain, which is the actual true one. But in the sort of your local view of this of the blockchain and whatever derived state you want to look at, let it be the price in a different liquidity pool, for example, well, you have to take care of this, because you process some transactions, you modified the state, but suddenly you're made aware that some of these transactions are, well, reverted. They sort of never really happened. And this might be due to this sort of large chain reorg, or even just simply that the node that you use to connect to the blockchain just received the node from, this is like a peer-to-peer network, right? So it received the node, the block from some other node, but that wasn't actually the true canonical head of the chain. So it happens in small and large scales, and can actually happen quite a lot. So you have to build your systems around this to sort of be compatible with this eventual consistency that you have.
And for me, that was an interesting thing. So traditional finance, you don't have that, right? You very, very rarely will have like a rollback or a step in from an exchange, whereas this is now embedded in the ecosystem of the blockchain, which is pretty cool. And so yeah, like using the mempool to your advantage just to make sure you order things in the right way is pretty exciting stuff. Even if you're going to do ethical things with it, but just to get the sequencing correct and things is pretty smart.
Yeah, I think. Oh yeah, go for it, Robert.
Well, I was just going to ask, what about like how do you, like, I mean, because obviously, because I wanted to wear a tie on this podcast because I've been in traditional finance for so long, I think about edge, I think about speed. Carlos, you touched on that. It's like obviously they're like you still have to be fast, but it's not the same arms race as in the traditional world. So like is it just like a smarter algorithm? You can't be faster. So it's like three legs of school. You could be first, you could be smart, you can be fast. And fast is not really it. Then you just have to be smarter. It's better algorithms. How do you acquire an edge?
Yeah, I mean that's absolutely right. You only have to reach sort of a fastness threshold, right? Which is sort of the time at which blocks get created, and once you reach that, being even faster will only lead to very, very marginal edge over competition. So there are other things that you have to take care. It's like the technology obviously is quite a bit different from CeFi or traditional finance technology, or you have to connect to the blockchain, you have to understand the state, and I think this is one of the things where you really have to put resources into it. Understanding how do these smart contracts, which sort of are the underlying technology that run these liquidity pools or these AMMs, how do they work? How can you monitor their state in real time? All of that is, again, the space is very premature still, so there isn't so much existing infrastructure around these things there are like very few providers where you can just go and receive a stream of the state of the world. So you have to go in, analyze these smart contracts, analyze how they work, how does the financial mechanics of these AMMs in this case work. So this is something that you have to do in order to get an edge over others.
If I can dive in there for just 1 second, because Niklas is 100% right, but just to maybe give context from the perspective of someone who's put together and built systems for large financial institutions, in no way, shape, or form do they currently have the DNA and the ability to do this as an organization. Like they might have one or two like forward-thinking people on staff that do this as like a hobby or involved in this, but like if you think about, as Matt and Niklas were talking about, sort of like this concept of even small things like a chain reorg or being eventually consistent, like it is a fundamental paradigm shift as a organization to imagine your systems and your risks as sort of like having to be tolerant across these like global distributed computing chains. it's a massive thing to introduce sort of a concept of a whole new paradigm of like, all right, now if you're going to do this and you're going to do this like professionally as a business, you really need to understand the language of a smart contract, and you really need to understand your contract risk. This is all stuff that's like so unheard of, and large financial institutions are going to have to go out and make some massive hires and retool a lot of their existing workflows to get out of these embedded learnings from TradFi and understand how the DeFi technology world works. And I would even say that even some of the incumbent like DeFi providers are A, still figuring this shit out, and B, are still very nascent in their product offerings, such that I personally wouldn't want to trade on that information. So like you really, really, really need to understand and trust the code before you can put real capital at risk at these types of things. And so it's not a long-term competitive advantage, but it's certainly a barrier to entry.
Yeah, one good example I think that highlights this difference is in the traditional world you have a few currencies that you trade, and you have pairs like the classical pairs, euro to US dollar or something like that. You might have a handful of exchanges where you can do that, but okay, once you have understood the different, maybe slightly different schemas or data structures that each of these exchanges use, you can just plug it in and have your system ready to go. On blockchains though, you might have thousands or tens of thousands of different currencies or tokens that you could trade. Like on Uniswap, for example, on Ethereum, I looked like a year ago or so, there were over 50,000 different pairs that you could trade. So if you want to have understand all of them, then you need to have a really completely different infrastructure. You can't just look at the main pairs and go and trade them if you want to really capture everything. And then the next thing is, there is also still a lot of scamming going on, right? You have to be careful. You can't just trade every token, because some of them might actually be written in a fraudulent way that steal all your money. So there are things to consider that are just not relevant in traditional finance, or just don't appear there, that you have to take care of when building your technology, and then when building your trading strategies, and when actually executing stuff. So there are many new challenges that come with DeFi.
Yeah, I think one additional thing is a lot of those different venues in CeFi will be using a standardization, so FIX. So that's a standard messaging protocol for traditional finance across asset as well. So it wouldn't just be FX, it applies to most asset classes. There isn't such a thing for DeFi. Like they can be very bespoke, and depending on what you're trading on, what chain, they're all different. So there's a lot more overhead in order to get access to different products.
Yeah, this is you have similar standards, like the ERC-20 standard that describes how currencies or tokens work and the basic data or data structure that they follow. But then I think the issue is much more how trading venues work, and you have many different implementations of automated market makers that all behave differently. That you have to analyze each of their code or documentation, which is often poorly written. So you have to really dive into the details, and in order to understand or make sense of the data that's coming from the blockchain. Even if it might be in a standard form, you still have to go through the implementation details to make sense of it.
Yeah. I mean, to dive into actual details, I remember when we did our implementation locally. The way that you build a traditional finance system is everyone would use FIX or some predefined specification, and that they might have subtle differentiations, but effectively you just have a translation layer that says, all right, this is one venue's FIX protocol, and I set this up, and then I put those messages into my system, and once I've got that subtle translation layer complete, any venue is sort of ubiquitous. Or fungible. I can just sort of move back and forth, and I can set up across venues, and it's somewhat commoditized to set up to a new trading venue. You just kind of plug your code in. You have a fixed specialist work out the subtle minor differences between someone's fix. You do a couple tests, and then bingo bango, you're off to the races. It's actually quite different you have to write a complete new class for each protocol because they have their own implementation of a smart contract. So like the level of effort to sort of like get even just a single venue on board, is a full process, because even with Uniswap you can't just read the white paper. You actually need to go into the code and find the nuances and figure out how that's different. You just kind of need to really be nuanced and dive into the weeds.
Very interesting, you guys. What about something around like talking about a little bit more about financial mechanics, the differences, obviously, similarities between CeFi and DeFi. Touching on a little bit more on that would be really interesting to me.
Yeah, so I think let's keep to the example of a Uniswap pool, because we've mentioned that quite a lot. In a way, it is working very differently from a central limit order book. I'm not quite sure how much you've discussed in the previous episode, so please interrupt me at any moment. But otherwise, I will now just go on and tell you all the details about it.
You'll see it much more interesting than I did, so go ahead.
So, because it works on this globally distributed computer and essentially just by a single formula, and also for some other reasons, like this global computer isn't that efficient, so you can't just individually match buyers and sellers like you might in a central limit order book. So that's how these constant product automated market makers, that's how they're that's the category that Uniswap would fall in. So that's how they solve this issue, right? They have limited resources available and then also limited liquidity, actually, and they still want to have working, functioning markets. So that's the entire market is driven by a single formula, essentially. And the way it works is that the makers provide liquidity to this, or liquidity provisioning, as it's called in the DeFi space. They provide liquidity to these pools by just depositing the two currencies that are being traded as reserves into this pool. And then essentially the state of this pool is given by the amount of these reserves in the two currencies, as well as the current price. And like I said, you don't match buyers against sellers, but if someone comes in and wants to trade, like buys some ETH, for example, we know that buying ETH in this case would increase the price. So this is, in a way, is a change of the state of this smart contract. And then there's formula essentially calculates or tells you how much US dollar you would have to pay and how much ETH you would get from that. That's like on a maybe even very technical level how it works. And that's very different from an order book, where you have, like, let's say roughly you have levels on the ask and on the bid size that sort of represent the willingness to either buy some ETH or sell some ETH at a fixed price, the order book level, in a way. Different from that, the DeFi pools or the Uniswap pool can have an arbitrary price. It's not bound to fixed levels like on a central limit order book, but can move like to any price in between. And that's because this formula is just a nicely beautiful, smooth formula that can give you any price in the end after this, after a swap happens. You can, though, sort of get or like a mathematical representation of the order book. Of the Uniswap pool that looks very much like a central limit order book. So you can also sort of split it up into different levels and look at what is the full amount of currency that I could trade within that level. And this way you can find something that looks at least very similar to central limit order book, like from the financial mechanics perspective. Although again, right, on a order book, you would jump sort of to the next discrete price level if you've used all the liquidity at the lower level, let's say. And on liquidity pools on Uniswap, this is very different. You can smoothly interpolate between these two and end up at any price in between. So these are sort of on the detailed side, like some differences or even similarities between the two.
Yeah, I think one thing that sort of Niklas mentioned here is that we won't go into the exact details because not all of our only 50% of our podcast moderators at the moment have physics PhDs, and maybe slightly
at the moment is the correct phrase. It's never too late to get a physics PhD.
Exactly. Maybe in my my third act in life, I'll go get a PhD, and you guys can write my letter of recommendation. But point being, we won't go into the exact math, but I do think that there is a very, very powerful idea here, which is that while the financial mechanics of both are quite different, you can basically develop a construct that allows you to translate information with minimal loss, with some loss, but with minimal loss, from a DeFi pool into a CeFi order book, and vice versa. And to me, I think that is actually a really powerful idea, in the sense that you can take information from a DeFi pool and you can take information from a CeFi order book, right? And you can marry them together, right? Both of them become a view into the total liquidity of the market. And so if you have a common mechanism by which to describe that, right, and you can use each of those as a component in your sort of trading strategies, right, that gives you a really, really, really powerful way to think about, to model, and to represent your risk, represent alpha, represent your total view on the market. So while it's not a perfect translation, I think it's still a useful translation. I don't know, Niklas, do you agree, disagree? What are your thoughts
I
on
think
that?
the term that you said, like loss of information, that's really the key concept here. So best case, you would want to find like a generalizing structure, a mathematical structure that fits both the central limit order book and the liquidity pool without loss of information. But if you just want to use sort of similar concepts as in traditional finance, it's quite beautiful actually. I think that you can translate a Uniswap pool into an order book structure with minimal loss of information. You can keep enough of the information that you can do interesting things with it, run trading strategies based on it, for example. Right? So yeah, I very much agree with this view.
Yeah, and I think this sort of kind of hints on the way that we view it, and sort of like what our like grand unifying theme of it is sort of like, if you want to have access to liquidity in both CeFi and DeFi, and you can represent them, that gives you a much better view on the entirety of the market. So rather than being myopic and saying to ourselves, right, what's the best way to extract the maximum possible value by nicking arbitrages back and forth between things, which to be honest is very fair, and at some point in time we may choose to get into that business if we can do so ethically. But really the primary driver is like, if you have this overarching view of liquidity in the market from both DeFi, which is a massive component of the market, and CeFi, which is an equally important part of the market, then this kind of opens up a world to engage in lots of different types of trading structures that give you the ability to sort of maximize your liquidity usage across both.
And you would have made Niklas and I very happy if you'd said grand unified theories then. And we would have been like, you're well on your way to a physics PhD.
I was thinking,
CeFi, DeFi, grand unified theory. I love it.
Oh, see, well, had I known, I would have jumped into that. See, this is why I gotta improve my education. But once again, I'm just a poor boy from Nebraska. I do the best with the hand I was dealt.
But I think you're making a very good point. That is sort of the combination of CeFi and DeFi world is, I think, where a lot of potential lies. And we've seen the development of DeFi over the past years, and it was sort of isolated to itself at the beginning, maybe in a way, and developing all by itself. And there are actors like DAOs, for example, that very much rely on the DeFi infrastructure and have to rely on it and cannot use other infrastructure. But I think like combining the two and using liquidity from both and the advantages of both can improve both markets actually. So I think this is where a lot of potential for the future also lies.
What about how technology? How do you mean? We were talking about CeFi and DeFi liquidity pools and trying to mirror. How does the technology differ between those two? I imagine it's quite different. I mean, just like talking with you about how visible information is, paying for these per transactions. I imagine technology is vastly different.
Yeah, I mean, we've actually touched on quite a few different aspects of this, right? For one, so DeFi liquidity pools are run on blockchains, these globally distributed computers. Yeah. So that comes with some limitations, mostly like resource restrictions. Then that is because you have to pay for every computation that you do. Essentially, you have to pay gas. So you want to reduce that to an absolute minimum, and that's also how these constant product market makers, the Uniswap, came to be, as a way to, with a limited amount of resources, make a market essentially. What is actually very interesting though is that it seems that we have layer 2s by now, things like Arbitrum, Polygon, and also completely different chains, for example Solana, which is very fast, and you've seen the development of central limit order books on chain there, but still today these constant product market makers dominate. Like I think the ratio is about 80% of the total volume is being done by them, and you've seen this increasing over the past year or so. So it seems that like even though it came from like technology requirements, the concept behind this sort of still lives on, even though nowadays where you can have access to different technology. But then, so coming back like to the actual technology that analyzed both of them, I think one of the key differences also is that you run everything on this global computer, and that also means that access to it is like global and very much democratized. You can't like locate the exchange in a data center and put your stuff right next to it, because nodes run everywhere in the world. Like many of them do run on AWS, but they could run in any of the AWS data centers essentially, and you have no idea where exactly the next block, so that the next state of the world is being produced. It could be literally anywhere over the world. So that is something that is also very different from the traditional world, and it's also a way that sort of democratizes access to it. Right? It's not that you have to pay a lot of upfront costs to start doing interesting things on it, and it very much relates to this speed arms race that we also touched on earlier.
Yeah, but I think it is interesting in a sense that like it can happen anywhere, right? You're not going to co-locate with Ethereum, right? Like Ethereum hasn't rented owns like a big data center in New Jersey, and so now you've got to pay the Ethereum Foundation $1 million a year to co-locate next to them. But that being said, there is still advantages to owning and operating your own node versus using like a third-party provider that may or may not put you on an AWS instance with like 800 other paying customers or something along those lines. So I think that there are still some optimizations that can be had in terms of like owning your own infrastructure and maintaining a node, but that also adds more complexity and difficulty to your life.
What I think is actually quite interesting in this is when you run your own node, you essentially sort of help running the infrastructure for these exchanges, or you run the exchanges themselves in a way, because you're sort of you're running the node that is accepting new transactions, processing them, and wrapping them up in a block and publishing that to the rest of the world, if like your node gets selected to do this at a point. So that's also something that wouldn't be at all possible, right? You can't go there and ask NASDAQ, could I please also process some of the transactions for you, and then keep some fees. Like that's absolutely impossible. So that's also a very interesting aspect that has only become possible with blockchains and crypto.
Yeah, and I think even if, for example, you don't want to engage in what I would call like dubious shenanigans on chain, it still is beneficial to have your own node and to be able to look at them as quickly as possible as you can, so that you can understand ways that people might be manipulating your own pricing or your own swaps against you. So it's just because you don't want to maybe participate in the shenanigans doesn't also mean that it doesn't benefit you to observe the shenanigans and learn to protect yourself against them as they come.
Yeah, you actually have to find ways to protect yourself against this, right? I think this very interesting article that sort of started to explore this MEV world was called something like Ethereum is a dark forest, and that's really what it is. Like, it's a dark forest, and there are a lot of monsters out there. And if you're not careful with your transactions, they're gonna eat you, or all your lunch at least, like all your ETH or whatever. So running your own infrastructure for that is certainly something that allows you to react fast enough, let's say, if these things happen. And there are also other alternatives, by the way, right? Especially for normal retail users, we see the emergence of like private transaction pools and also things like payment for order flow, which we've seen in traditional finance, which somewhat tries to solve these things, obviously bringing maybe some other issues. But so there are many different ways to go about this.
And we were talking a little bit more. You kind of touched on it, just like some of the technology constraints. And one of the things I was interested in exploring more was also the future of DeFi. You touched on things like Solana, which obviously is a lot faster. It enables central limit order books a little bit more, as far as I understand. As a non-tech person, like that's kind of how I understand it. Obviously, automated market makers came into market because there wasn't a whole lot of liquidity, so they were trying to find other ingenious ways around that. And now with Uniswap's version 3, where you're having narrower bands, it's kind of like merging more towards a central, like at least from my view, that's kind of seems what it looks like. But if we look at in the future, let's say as assets are tokenized to greater extents and there's more liquidity, more market participants, do AMMs, for example, just become irrelevant, as there's more liquidity coming in?
Yeah, so I mean, I think that this was sort of the expectation a long time, but I mean, I've touched on this earlier as well, that statistics show that AMMs are growing and like order book implementations on chain are declining actually. And I think sort of what you said, that Uniswap v3 moving closer to what an actual order book is, this might be more what we will see in the future. And it's not one or the other, it's somewhat like in between, a new concept entirely that in the end increases capital efficiency and still allows to be run on chain. So I think this is sort of where we're probably going to, and like increasing capital efficiency, mitigating impermanent loss. These are the things that will be tackled in future implementations, and we're seeing sort of many propositions for this, right? Ways where you use the liquidity in your protocol more efficiently, like not split it up into many separate silos, for example, or allowing like one-sided liquidity provisioning. These are all like innovations from the financial mechanics side that might be interesting in sort of mitigating these issues. But I think we'll probably not see like pure order book implementations in the future. So at least so far, it's not looking like it.
So is it? So do you feel like? Sorry, I'm super curious about this. So do you think, like for example, Solana, that's like one of their main like strives is that they can be able to create this. So you feel like this demand for that might not be as needed?
Well, I mean, still most of the liquidity is sitting in Ethereum, right? And I mean, Solana has some issues. It's not very stable at the moment, so that's probably preventing it from attracting more liquidity. But this might very well change, right? We see large players coming into, I think it was the Jump crypto division that has started to build like a new client, like very stable, like using all of their experience in building this kind of infrastructure for it. So that might change it, and we'll have to see if like improvements in the technology will also lead to in the end more liquidity coming to it. Hard to predict, I would say.
It's so fascinating to look. Oh, sorry, go ahead, bro.
I think one of the interesting things about this is why is speed such an important aspect of TradFi markets, right? Because it's not a thing. If you go to like a pension fund, right, or a retail investor who is allocating a portion of their capital into into an investment, nobody is saying to themselves, man, you know what I really want? I want to get into this faster. Like I need to be able to execute this in 8 microseconds versus 10. No, it's totally made up. The reason why speed is so important is because exchanges learned long ago that they actually made more money by renting out data center spots and by selling data to high frequency market makers than they did by earning transaction fees from customers. Right? And so this concept of speed and the ability to be the fastest to a trade, so it's just that you can get in front of it and make more money and extract maximum value, right, is more of a construct of like a principal agent problem, right, where the exchange whose fundamental priority should be, right, protecting clients, has moved towards how can I make more money, and the way that I make more money is that I sell data and compute resources to high frequency traders whose experience is extracting as much as they possibly can from the people who are using the exchange. So my personal view is that why are we trying to race to recreate that on a blockchain, right? Like we don't need to recreate that on a blockchain, but sure we need to get sufficiently fast. But really, if you, like, what problems are we trying to solve as sort of a society? Is sort of like how can we generate stable and fair liquidity? And as Niklas said, I think quite well, I don't think that AMM is the end-all be-all, but I certainly don't believe that like a central limit order book with sub-microsecond processing times is also the end-all be-all. They're sort of like artifacts of like how the market grew and evolved. And my hope is that we can get to something that's a bit more fair that solves that fundamental problem of like how do we give stable and sound and fair liquidity to all market participants, rather than how do we make sure that we've got a market structure that allows a small subset of market makers to extract the maximum amount of value as they can out of the ecosystem.
I think this is a very interesting point, and so since especially on Ethereum you're limited by the maximum speed you can reach, what we really see is that protocols like Uniswap, they've been putting resources not in improving speed because they can't, but rather like getting the mechanics, the financial mechanics, improving that in order to get the best outcome for the users. And this is something that we'll probably see even more. And then on the other hand, Uniswap doesn't make any money on Uniswap. They have the protocol fee in theory in the code, but it's not turned on. And I think part of that is because they're afraid of the SEC if they make money from their products. But still, like what you see are like these alternative business models. Uniswap is huge. They're worth a few billions, I guess. And they have sort of really fostered an ecosystem around them, starting to themselves invest in other like startups and protocols. And they've been able to do this like without making actual money from their core product. So I think this really shows that, maybe due to some historic limitations and historic special circumstances, but still there are alternatives to the current system that might work more to the benefit of all if you follow them and develops better products in the end.
That is, it's so interesting hearing you talk, Niklas. You have such a wealth of knowledge. I was kind of curious, like, I know a lot of our audience, they're interested in the crypto space. Do you have any recommendations for people that are looking to get into it? How do they get up to speed on the space? You have a fantastic technical background, just like how you went about acquiring it, and any tips and pointers for the audience would be great.
I think the best way, really, as it is probably with most of these technical or scientific things, is just get started building something. Right? That's also how I really started going to it. I was messing around with MEV a little bit, unsuccessfully, so I didn't do any bad shenanigans, actually. But still, I got curious by some things that were possible there, and I just wanted to explore and try out. So that's how it all started for me. I was just starting to build a little thing. There are plenty of blog posts and tutorials online that show you how you do these kind of things, and really only if you build with it and use it yourself, then you can really start to sort of gather this knowledge all by just by playing around with it. So this is, I think, really the best recommendations that I can make. I mean, okay, my background is special, and sort of my analytical or my mathematics education helped me a lot in diving through this, but it's not really necessary, right? You can still try to read the white papers or read other blog posts, or even go into plenty of these forums that exist, like Discord channels, where a lot of people are keen to help you if you have any questions. And this is really also something very special and nice about the crypto community, that they're all there to help each other. If you have, if you can just go and ask and then get started building stuff.
I love that. Thank you so much, Niklas. And Carlos, I think we're, you mentioned to me, we're going to be publishing, you're going to be writing a blog post.
Yeah, Niklas and I are going to be teaming up on a blog post to go over this. Awesome. Yeah, we're, like I said, this is a huge, strategic, I'm not going to call it a shift, but more of a direction we're taking at DeepQ to build out DeFi capabilities, particularly on the intersection of CeFi and DeFi, and ways to better understand sort of DeFi from a risk management as well as a sort of information or market information source. For us, it's really exciting. I think the economics make a lot of sense, and most importantly, as you sort of tell by Niklas and I's sort of last little rant about democracy and fairness and feel-goodery in the market, I think. Obviously, we're a for-profit business, but generally speaking, I like to divert attention to things that I believe in personally, and I think that this has a lot of possibility in terms of its ability to generate fairer, more inclusive, and better for market participant sort of market structure. So it checks a lot of boxes for me, and we're really excited to allocate a ton of resources there, and we're excited to be working with Niklas as a consultant to sort of like bring us up to speed and get us out of our old stodgy TradFi ways and more into DeFi. I'm gonna start calling people friends soon, FREN, and using old terms like WAGMI. Although like if this is any indication of how I am in my normal life, because I'm full on 40-year-old dad now, I'm gonna start using it about 5 years too late, and I'm gonna walk up to the party, be like, "Yo, hey friends, wag me."
Why are you being sus?
How's your riz, bro?
Yeah, love it. I want to be there when that happens, Carlos.
Totally.
But thank you so much, Niklas. Really appreciate it. If there are ways for the audience to find you, if they're interested, let us know. If you have a website or email.
Easiest way is via LinkedIn, I guess.
Okay, great, excellent. So look for Niklas Henke on LinkedIn. Sir, it was great chatting with you. You're a brilliant guy. Thank you so much for joining us.
Yeah, thank you. It was a lot of fun.
Take care, everyone.
Cheers, boys. Have a good one.